Great stuff. And that concludes the first portion of the five things, Gary. We're going to move into thing number five, investment, research, education, knowledge. Today, we're talking about risk, Gary. So for investors wanting to own stocks, but worried about the risk, we're going to talk how does changing exposure maybe eliminate risk and all the other things associated with risk that you need to know. Thing number five, Gary, some ways to hedge risk. Tell us a little bit more about hedging.
So, Rob, one of the things that always surprises me is professional investors spend a lot of time thinking about risk and how to hedge risk. And there are lots of ways to hedge. We'll talk about a bunch of them today, but it basically means either reducing your exposure or changing your exposure or isolating some sort of exposure so that you're only taking the bet that you want to take or buying insurance against things. And the amazing thing is, amateur investors, individual investors, rarely look at it, rarely think about it. Registered investment advisors, the RIAs, the wealth managers, unless you're ultra wealthy and have someone who's really good at it, you're probably not getting covered in this way. And they all act like, shorting something is somehow like this crazy dangerous thing to do, but being 100% long all the time every day, that has its own risks. And so, we're going to talk now about some of the kinds of things that professional investors do to change their exposure or limit their exposure. These are the kinds of things that are available to you as an individual investor. And if you want to start thinking about these things, great. And if you want help with it, this is the stuff that we do really well.
Gary, there are multiple strategies that are out there. One tool that you talk about first is a put option. Gary, what's a put option? Tell us how that can be utilized.
Well, so it is a put option gives you the right, but not the requirement to sell a stock at a particular price. So, for example, we were just talking about Talent Energy and, how we have such huge returns in that. And thanks, Enrique, for that. So the stock closed today at 209. And let's just imagine for a minute that I'm saying, I really love owning this position, but I have a lot of profits in it and I don't want to sell it and I don't want to pay the tax bill. And I think there's more upside, but it's run up a lot recently. It could go down. So what you might do is you might buy a 200 strike put option, 3 months out from now. And what that would do is say at any time over the next 3 months, I have the right, but not the requirement to sell Talent Energy stock to whoever uh, uh, sold me that put option for $200. And in the hypothetical example, if Talon were to drop below $200, like 190, 180, something like that, we could force the person who bought the option, sold us the option to take that price. We'd say, we're selling it to you and we don't care that the market price is 180. We're selling it to you at 200. And that's what the contract does. So that gives you the ability to protect your position and say, okay, if it goes down, we'll take some losses, but if it drops below a certain point, we're covered, right? We've hedged out that risk.
Gary, insurance on these types of premiums, you're paying for that. Explain how insurance gets worked into this equation here.
All right. So the example that we just gave, we were saying, okay, what if you bought Talent Energy puts, the $200 puts? Those aren't free. Nobody's writing the risk. Nobody's taking the risk that they'll have to buy that stock 10 or 20 or $30 below the strike price. The strike price in this case is that $200 number. They're not taking that risk for free. You have to pay for it. So it's like anything else, Rob. You have a house, you buy home insurance. If your house burns down, you have the insurance to reimburse you. If it doesn't, that insurance costs you something. And it's the same thing in this situation. So imagine that, we were to buy those 200 strike Talon puts and, the stock, instead of going down to 180, what if it goes up to 280, which is where Enrique thinks it could run in the next few months. In that situation, we do really well in the stock, but we would lose the premium or the price that we paid for those put options or that insurance, the options would expire worthless. So, you need to think about how much are you willing to pay to protect your downside, and it's okay to pay for it and it's okay to lose money on it, but just don't think that it's free. You can't be covered for up and down and sideways and not have to pay something for it.
Gary, you also talk about asset exposure. Tell us how asset exposure could be another way for you to hedge risk within your portfolio.
So, Rob, when people talk about diversifying their portfolio, they typically will talk about it in terms of, well, you should own a certain number of stocks. Now, some people say, a dozen stocks is enough or 2 dozen stocks is enough. Other people have portfolios where they'll have 200 or 300 stocks. And so, one way you can control your exposure is to own more stocks so you're not as exposed to the possibility that one of them will blow up, right? You don't want to have a single asset portfolio. But another way that you could do this is diversify across various industries. So, for instance, I own a lot of energy positions, but I also own some some micro cap, ultra high growth positions. Those stocks aren't going to move together. And so we're diversifying. I like owning medical stocks. We've owned technology. We've owned insurance and healthcare service providers. So when you own different kinds of assets, that way you're not as exposed to one thing happening. One bad event doesn't change everything for you. You can also diversify across asset classes, right? I focus a lot on equities, but you could buy bonds. I wouldn't recommend it right now, but you could. Things like Bitcoin, gold. So there are lots of different options, and you want to take advantage of at least some of them.
Shorting, Gary, pops up a lot when you talk about diversifying a portfolio. Tell us more what that means, shorting in regards to stocks, industry, even market indexes. Gary, what is shorting an individual stock or position like those mentioned?
So, Rob, shorting is misunderstood. People often refer to it as being wrong or immoral, that there's something, crazy about it. People refer to it as risky and dangerous, as if being 100% long every day isn't. I view it as a tool to reduce risk. Now, for people who don't know, shorting a stock is simply the same thing you do when you buy a stock, except in reverse. So if we think about just buying a normal stock, right? So Rob, you would buy a stock and you hope that it goes up and you sell later at a profit, buy low, sell high. You've made a profit. Congratulations, you've done really well. When you short a stock, you do the same thing, but in reverse. What you do is you borrow the stock and you sell it. You sell the stock that you don't own and you get cash. And then, hopefully, in this hypothetical example, the stock will go down. And when it does, you can take that cash, repurchase the stock at a lower price, return the stock to the person who lent it to you, making them whole. They lent you 100 shares of Talon. You return to them 100 shares of Talon, but you end up with more cash because you sold high and then bought low, right? So when you go long a stock, you want to buy low, sell high. Shorting, you want to sell high, buy low. That's all it is. And these are tools that we use to reduce our market exposure. It's something that I use a lot to isolate my stock picking ability. I may buy a bunch of stocks I like and short the market against it. And in doing so, I'm creating pure alpha, which is just a fancy way of saying I'm isolating the effect of the market on my positions, on my portfolio, and just saying I'm going to live with the outperformance of my stock picks over what the market does. And that's a pretty good way to do things because I'm not taking market risk, I'm taking skill risk, and that's a bet that I'm willing to take.
Interesting. Gary, at DKI, you use a lot of different hedging strategies. One of them positions in uncorrelated assets. Gary, tell us two of your favorite positions for reducing risk.
So, Rob, when people talk about uncorrelated assets, they often will talk about privates. That's not really viable for most investors unless you have a lot of money. They'll talk a lot about real estate, which tends to be uncorrelated, not always. Again, those tend to be private. But for me, my favorite uncorrelated assets are gold and Bitcoin, not in that order. Um, those are positions that will benefit from a decline in the purchasing power of the dollar, something we talk about pretty much every week on this show. And that will continue. And it would have continued regardless of who won last Tuesday's election, whether it was Team Red or Team Blue. The dollar is going to be continue to be debased, which is just a fancy way of saying losing purchasing power. And so we have these non-financial assets, things like gold and Bitcoin, that don't have a return and they don't have fundamentals. But what they will do is allow you to put some assets in things that are not correlated to the market, but which will benefit from a decrease in the purchasing power of the dollar. And so I'm a big fan of both. My Bitcoin position is much larger because that has just run up an enormous amount, where I have good profits in gold. We have insane profits in Bitcoin.
Great stuff, Gary. Covered a lot of ground there in thing number 5. If you've got any questions you want us to cover on the show, please leave it in the comments. Send email into ir@deepknowledgeinvesting.com. We'll be sure to check those out and consider some of those questions for our 5th thing as we continue to pump out new editions of the 5 things. Gary, this wraps up this week's version. The President-elect Trump loves Bitcoin issue. Great discussion. Saw Bitcoin hit 90K on the show. Lots of good conversation, exciting things happening. We're going to keep you in tune with the good, the bad, and all the indifferent in between. Gary, closing thoughts from you.
Yeah, remember, everyone, whether you're elated by last Tuesday's results or dismayed by them or apoplectic, whether you think the market's good or bad, there are always ways to make money. It's our job to figure that out. Tonight's show, we talked a lot about a variety of pretty complicated things, especially in that last section. These are the kinds of things that we help individual investors with. At our core, look, when we do this show every week, we're really focused on investor education. And what we want is for you to understand the stock markets, the economy, finance better. And if that's all you get out of this, terrific. I would love to live in a country where more people understand what's happening in the financial world and the markets. And we're so happy to help you with that. But the real core of what Deep Knowledge Investing does is to help people make more money. It's the stock picks. It's the uncorrelated assets. We were buying gold and Bitcoin years ago. Our energy positions, we were buying uranium years ago. These things have all gone up multiples. So, if you feel like that's help you're interested in, these are the things that we do on a daily basis to not only explain these things to our community, but to help people make money from it and help people make money from situations that may not always be pleasant or attractive or what we want them to be. So feel free to reach out, ir@deepknowledgeinvesting.com. Feel free to subscribe. If you're not sure, avail yourself of the free subscription and check it out for a month or two. And then, see if you want to join us to make money with us. That's really what we're doing with the premium subscription. So we'd be happy to have you and help you. In the meantime, if all you do is spend your time with us here, we know it's valuable. Want to thank you for your time. And we'll look forward to seeing you next week. I can tell you it's only Tuesday, but Andrew and Alex already have some pretty hilarious things coming up. And we are going to be poking, I think, next week at one of Bitcoin's biggest critics. So stay tuned to see who we're taking aim at next week.